let's get a dimension to this big picture too. Pete McGuire from XM.com is live in our Sydney CBD studio. Pete, welcome to the show. A figure that sort of jumped off the page at me, Citi noting now that managed net long positions in futures, the smallest since January 2016. So any notion of a sustained price rise is clearly not being expressed on that trade.
Well, good afternoon, Carsten. You'd have to agree there. I mean, they're very interesting numbers. And when you take on board that, moving forward, we've got a lot of outliers that I think are going to have impact over the next couple of months. The GE/Baker Hughes amalgamation, we're looking at what is happening in Iraq with possibly the end of ISIS, increasing production there, and of course the net longs and as far as hedge funds. You know, the market, Adam made a point earlier, Carsten, we were up about 5% last month, and it had a really nice jump last night, and New York up just over 2%. So that was very, very strong, and it's not uncommon to see those big rallies continue.
Pete, just on those ebb and flow net long position stats, do the speculators have form when it comes to calling this in the right way? What kind of a back check are you doing to sort of tally up right from wrong?
Well, when you look at how the hedge funds have performed since mid-14, there's been 5 cycles. They're traditionally quite manageable, and they really do pick that market movement. And they've been able to drive markets lower and then, of course, turn the markets around. And what we've seen in the last the last week and a bit has been a very strong uptick, up about 7%. Look, I think overall hedge funds do very, very well, and money managers with those positionings. And it just takes on board where they're probably oversold over the last couple of weeks. It had a really big washout, and it's seen a bit of a reversal. So they might, start to add positions as the week goes on, just to wait and see.
And as you kind of now digest everything that's happened in the last few months on shale, on the problems in the Middle East, specifically on Qatar and the Saudis, maybe even the IPO that was slated just gets scrubbed, heaven forbid. What are your conclusions?
Well, I think overall, if OPEC are going to continue this mantra in which they are, and as far as production cuts, everything rolls forward for the next 6 months leading, and we don't have any geopolitical concerns or weather outages, then I think oil will probably trade around that $50 barrel. It might go a little bit higher, it might go a little bit lower. Remembering another thing, you had a big washout as far as nearly 5% off for the US dollar, the largest sell-off, I think, in a quarter, going back to about 2010, so that April to June quarter we've just experienced, big hemorrhage. We've seen the US dollar turn around last night as well. So those factors have got to be contained and got to be understood how they wash into a market.
Mm-hmm.
Pete, it's Adam here from Shaw's. Our analyst the other day, and sort of it's a little bit of a long bow to draw here, but he was sort of saying that iron ore is a little bit of a precursor to what the oil price is going to do. And he sort of put a chart up of the iron ore and the oil price, and then saw that iron ore ticked up about a week or so ago, and then oil followed. What do you say to that?
I mean, I'd like to see an overlay, and it's probably some form of correlation between the two.
Yeah.
And when you do see that, both of them were sold off very, very heavily. So in turn, when markets do it could be coincidental. There could be something more there, Adam. It's not uncommon to see when you lay graphs over, you see US dollar versus crude, all different components, British pound, of course. So I think that, at the moment of time, I think if you push that up on a graph, it'd be interesting to digest it over the last 5 years to see if they're actually in tandem and lockstep.
Correlation, yeah.
Okay. Move into bullion, and the call for the next wee while. We've been seeing sort of moves in the greenback being a key driver, of course, of late.
Yes.
How much of the swing factor is that going to be, moving forward now, or is a lot now priced in on the Fed?
Well, I think where we take our mind, Carson, the gold market's off the best part of about $80, 6% since this time last month. So in turn, I think it nearly at $1,300, $1,297 on about the 6th of June. So when you take that, you look at the hawkish comments, you look at central bankers, starting to realise we may see rate rises and economies are growing faster, I think that's going to be a handbrake for gold. You could see under 1,200 if nothing really happens. Another point is that gold traditionally does languish in the June-July period. It's its slowest growth 2 months versus, what we used to normally see for the last 10 years as far as historical data for January. So it's not uncommon in this time of year. Let's just wait and see what that US dollar does and see where the Fed goes and, of course, other central bankers. But that's going to be the downdraft for, those hawkish sentiments going to be the downdraft for gold.
Now, the Goldman's connection to all the stories that inevitably get generated and the position they take, what kind of a metamorphosis are we now bearing witness to? Or this is a little bit of kind of a mislead on reality? How are you judging the kind of pivot away from, being in the front and centre of this story for so long?
Well, their earnings, Carson, I mean, a lot of the big banks are now out of their commodity trading, and when you're looking at Goldman's, they had a bumper year of 2009 of over $3 billion in revenue from commodity trading, and last year was 2016 was down to $1.1 billion. So that just takes on board that there's obviously less risk appetite. There may be less opportunity. Traders are possibly not prepared, and banks aren't prepared to, put their balance sheet to risk. It just depends on their own internal workings and, of course, what traders are doing. But if you look really where that oil market's been, you look at a number of those other commodities, they really haven't had, outstanding growth periods like we saw in the early part or the middle to the end of the OOs. And that may be why that profitability that was achieved in 2009 is, a record that will never be broken.
Do we worry, though, that the commentary somehow is going to be lacking the depth that we might have come to expect? I mean, not just Goldman's here, but, you pointed as well to the likes of Barclays, JP Morgan, Morgan Stanley, Deutsche Bank. I mean, they are a shadow of their former selves when it comes to commodity exposure.
Yes, exactly. I mean, there's still traders out there and there's still clients naturally hedging risk, but they could be looking at, different styles of hedging mechanisms. They may be just using straight futures. It just depends on their own appetite and, again, what they're prepared to do as far as risk tolerances. It's a different world today than what we saw in the last, say, 7 or 8 years, and that's been demonstrated by a lot of these big banks' profitability and, of course, looking for easier targets. So that seems to be the mantra moving forward. It'd be interesting to see where Lloyd Blankfein's thoughts are on this, because he started in the commodity desk, I think, at around about 81. So let's just wait and see if Goldman's do perform better over the next, say, 6 to 12 months.
On a soft commod story, and maybe just pegging this to the likes of a grain corp, noting that NAB's calling out Australian wheat production potentially set to slump by a third.
Yep.
That would still, though, see output around the historical average, but still the NAB call is that the risks are weighted more to the downside, a very, very dry start to winter following a mixed autumn break. Is that consistent with what you're hearing globally? And I'm just wondering how that might even feed into inflation.
Well, that's right. When you're looking at what's happening in the US, farmers are planting less wheat. We thought that soybeans and corn, there was a thought there that corn would have outstripped it, but it hasn't. So it's just another, I think, realisation. Less production's coming online. Let's see what happens. Again, the market's always very, very dynamic. You can sit there for 6 months or 12 months. You can have oversupply or undersupply. But at the moment, there seems to be, plenty of grains and wheat entering the market.
Adam, are you minded to be exposed to clients wanting the exposure in some shape or form to the ag story?
Yeah, look, I think the commodity side and the soft commodity side is a little bit tough unless you're sort of an expert like Pete is, because it does take a lot of effort to maintain a portfolio. I've sort of been more interested in the sort of the food bowl story, so the Costa Group, those kinds of things. That's sort of where I'll be sort of heading. But yeah, the soft commodities, it's a tough space. I don't really know too much about it.
Well, exactly. I mean, you've also, of course, Mother Nature. You're only having a look at cocoa at the moment, the Ivory Coast, huge rains and what impact that's having to farmers, just as an example. So it's not uncommon. Mother Nature can play a very devilish hand to the market, and it just depends on seasonality and of course, supply and demand.
Pete, we've had a fairly, the start to this winter's obviously been fairly cold, but also fairly dry as well. Is that sort of impacting anything sort of on the Australian side of things?
Well, I've been away overseas for a couple of weeks, but I think it would certainly impact, plant crops. It just depends as far as farmers, plant seedings, if they're not frozen. We're only, a few days into July. Let's see if we have, an increase as far as frosts. There's colder weather coming up from Tasmania, so that is going to impact, and I think it's just a wait and see over this, July, August period.
Pete, good to talk. We will check in with you soon, but for now, have a great week.
Thank you, Carson.
Pete McGuire from